A pair of British twins transformed golf forever with microchipped balls and an audacious $30 million venue experiment, then turned Topgolf into America's hottest night out. But their runaway success set a trap: debt-fueled expansion and sky-high costs. What hidden flaw made their growth backfire? The real answer begins at the very first swing. Steve and Dave Jolliffe grew up on the outskirts of London, always searching for ways to make golf more engaging. In 2000, after selling their earlier business, the twins launched an experiment in Watford, Hertfordshire. Their idea was simple: embed microchips inside golf balls to track every shot, turning a routine driving range into a real-time, score-based game. It was the first of its kind, blending technology and sport in a way that traditional golf had never seen. The Watford site opened with quiet ambition, but the local response was tepid. Most nearby golfers stuck to their old routines, and the broader community showed little interest. The Jolliffes approached the Professional Golfers Association for support, only to be turned away. Without the backing of established golf institutions, Topgolf found itself isolated, too unconventional for purists, too unfamiliar for everyone else. The technology worked. Each microchipped ball registered distance and accuracy, feeding scores to digital leaderboards. But the novelty alone wasn't enough to draw crowds. The venue was small, just a fraction of the size of what would come later, and the business struggled to fill bays. Revenue trickled in, barely covering costs. For months, the brothers faced the real possibility that their invention would remain a curiosity, not a movement. Yet the core idea, making golf accessible, immediate, and social, remained. The Jolliffes knew they had something different, even if the market wasn't ready to embrace it. What they needed wasn't just better technology, but a way to make Topgolf matter to people who had never picked up a club. Richard Grogan stepped onto the Watford range in early 2004 and saw more than a struggling driving range. He saw an untapped entertainment engine. By spring, Grogan and his partners pushed for a complete redesign. The new vision was bold: triple the footprint, add a full-service kitchen, install bars, and build out event spaces. The game would stay, but the real draw would be the experience, music, food, and a social atmosphere that pulled in everyone, not just golfers. The first proof came in Dallas. In February 2007, Topgolf opened a sprawling venue in the Texas heat. Within months, demand outpaced every forecast. 6-hour waits snaked out the doors on weekends, and the parking lot stayed full late into the night. For the first time, non-golfers made up the majority of guests. The Dallas site wasn't just busy, it was a sensation, validating Grogan's bet that people wanted more than golf. Investors took notice, seeing a model that could scale across the country, city by city. But each venue came with a price tag. Building a Topgolf meant $30 million up front, far beyond what traditional driving ranges required. Topgolf covered a fraction of that, typically around $7.5 million. The rest came through sale-leaseback deals with real estate investment trusts, or REITs. These partners financed the build, then leased the property back to Topgolf under long-term agreements. The structure fueled rapid expansion, but it also locked in steep fixed costs. As long as crowds kept coming, the math worked. If traffic ever slowed, those costs would become impossible to ignore. In 2013, Topgolf's expansion machine shifted into overdrive. 10 new venues opened that year, each one bigger and busier than the last. Word spread fast, both online and off. Social media feeds filled with photos of neon-lit bays, birthday parties, and group outings, turning Topgolf into a status event for millennials and Gen Xers alike. The experience wasn't just about golf anymore. It was about sharing a night out with friends, food, and music. By the end of 2014, annual sales rocketed to $163.5 million, nearly doubling in just 12 months. The company's mobile app, launched in 2013, let guests book bays and brag about their scores, fueling even more buzz. Operational teams raced to keep up. Every new opening meant hiring, training, and orchestrating a seamless party atmosphere at scale. Behind the scenes, construction crews worked year-round, transforming empty lots into sprawling entertainment complexes. The numbers told the story. By 2015, Topgolf counted 28 venues and welcomed 8 million guests through its doors. Lines snaked out to the parking lot on weekends in cities from Atlanta to Denver. Investors poured in more capital, eager to back what looked like a can't-miss formula. For a moment, the growth seemed unstoppable. Topgolf was everywhere, and everyone wanted in. By 2016, Topgolf's ambitions had outgrown the driving range. Leadership doubled down on technology, acquiring World Golf Tour to capture a booming digital audience, and snapping up ProTracer, a Swedish ball tracking innovation that became TopTracer. This move gave Topgolf a proprietary edge, embedding advanced shot tracking not just in their venues, but in televised tournaments and partner ranges worldwide. The company's intellectual property portfolio became a fortress, making it nearly impossible for rivals to match the experience without licensing Topgolf's own tech. The next leap came in 2020, when Callaway Golf struck a deal to acquire Topgolf. The logic was simple: merge the world's dominant golf equipment brand with the fast-growing entertainment juggernaut. Callaway brought deep pockets and global reach, while Topgolf offered a pipeline of young, tech-savvy customers. The combined company, Topgolf Callaway Brands, promised to blend hardware, software, and live experiences into a seamless golf ecosystem. Executives projected $2 billion in revenue from Topgolf alone by 2025, with Artie Starrs, an alumnus of Yum Brands, stepping in as CEO to steer the next phase. Then, the pandemic hit. While most of the entertainment world shut down, Topgolf's open-air venues and contactless gameplay turned into an unlikely magnet for stir-crazy crowds. 2021 saw a surge in outdoor activity, with new and lapsed golfers flooding back. Bookings surged, and leadership saw the spike as proof that Topgolf's model was not just resilient, but essential. Flush with confidence, the company accelerated its expansion, convinced that the demand would hold long after the world reopened. In 2022, Topgolf's numbers started to tell a different story. Same-venue sales fell by 10%, a sharp reversal after years of steady gains. The initial thrill that once packed venues faded, and for many guests, Topgolf became less of a habit and more of a one-off event. As repeat visits dropped, the company's financial structure left little room for error. Nearly 89% of operating income was swallowed by interest payments on debt, a burden that had grown heavier as rates climbed. For the finance team, the math was inescapable. With cash flow shrinking and fixed costs locked in, even a modest dip in demand threatened the entire business model. What had once looked like a flywheel of growth now revealed its fragility, exposing Topgolf to risks that couldn't be papered over by sheer scale or brand power. Cheaper rivals closed the gap fast. 5-Iron Golf and Big Shots built new venues for about a third of Topgolf's capital outlay, skipping the sprawling footprints and costly real estate. Their smaller, simulator-driven setups lured price-conscious groups who once flocked to Topgolf's neon bays. By early 2025, the numbers were impossible to ignore. Topgolf's segment revenue dropped $29.1 million year over year, falling to $393.7 million. Same-venue sales plunged 12% in the first quarter alone. Market analysts pointed to the mismatch. While Topgolf's fixed costs stayed high, competitors thrived on leaner models and lower prices. Facing shrinking margins and eroding loyalty, Topgolf's parent company announced a plan to separate the entertainment business from the equipment brand, a public acknowledgement that the growth formula had broken down. In an era of rising interest rates and shifting consumer loyalty, scale no longer guarantees survival. Every ambitious brand faces the same question: can experience alone sustain repeat business? Today, endurance, not novelty, defines success. The real test isn't growth, but how you weather what comes after. Share your thoughts below.